Welcome to part 3 of our course on Introduction to Banking. In this section, we will explore the diverse types of financial institutions that play crucial roles in the global financial system. Understanding these institutions will help you comprehend how money flows in the economy, the various services they offer, and their impact on consumers, businesses, and government policies. A brief history of financial institutions. The history of financial institutions is deeply intertwined with the economic development of societies. These entities have evolved from rudimentary beginnings to complex systems that underpin modern global economies. Here's a concise overview of how financial institutions have developed over time. 1. Ancient beginnings. The concept of banking can be traced back to ancient civilizations. In Mesopotamia, around 2000 BCE, merchants gave grain loans to farmers and traders. The ancient Egyptians also conducted financial transactions using grain banks. In these early days, the primary purpose of these institutions was to facilitate trade and store wealth in a stable form. 2. Medieval banking. The roots of modern banking systems began in medieval Italy during the 14th century. The rise of trade between regions necessitated a system to handle large amounts of money and credit. Italian merchants from cities like Florence and Venice were among the pioneers in developing banking practices. They introduced the Bill of Exchange, allowing traders to conduct business without the physical exchange of money, thus reducing the risk of theft. 3. The birth of central banks. The concept of central banking originated in Sweden with the founding of Riksbank in 1668 and was followed by the Bank of England in 1694. These institutions were established to help governments fund military operations and manage state finances. Over time, their role expanded to include regulation of the currency and control over national monetary policies. 4. The expansion in the 19th and 20th centuries. The 19th century saw a significant expansion of financial institutions due to industrialization. The need for large capital to fund industrial activities led to the growth of commercial banks and the creation of new types of financial institutions, such as investment banks and insurance companies. In the United States, the National Banking Acts of 1863 and 1864 established a system of national banks and set the stage for a more structured financial system. 5. The Great Depression and regulatory changes. The stock market crash of 1929 and the subsequent Great Depression exposed major weaknesses in the financial system. This led to significant regulatory changes, notably in the United States with the Glass-Steagall Act of 1933, which separated commercial and investment banking to safeguard deposits. Central banks around the world also increased their regulatory oversight during this period. 6. Late 20th century to present. The late 20th century saw the deregulation of financial markets, which led to explosive growth in global financial services. Innovations in technology further transformed these institutions, enabling rapid transactions and the emergence of new financial products. However, the financial crisis of 2007-2008 prompted a re-evaluation of the role and regulation of financial institutions, leading to calls for stricter oversight and more conservative banking practices. 7. The digital revolution. Today, we are witnessing a digital revolution in the financial sector, with the emergence of fintech companies, digital banking, and cryptocurrencies. These developments are challenging traditional banking models and creating new opportunities and risks within the financial landscape. Understanding the history of financial institutions provides essential context for gracefully and identifying future trends in the global economy. As we look to the future, it's clear that these institutions will continue to evolve in response to technological advances and changing economic conditions. 1. Commercial banks. Commercial banks are perhaps the most well-known type of financial institution. They provide a broad range of financial services, including deposit accounts, loans, and credit facilities to individuals and businesses. Their primary function is to accept deposits and lend money, thus facilitating the flow of money in the economy. These banks make profits primarily from the difference in the interest rates charged on loans and paid on deposits. 2. Central banks. Central banks serve as the primary regulatory authority in a country's financial sector and act as the bank of the government. Their roles include controlling inflation, issuing currency, and overseeing monetary policy. For example, the Federal Reserve in the United States, the European Central Bank in Europe, and the Bank of Japan in Japan are critical in shaping economic policy and stability. 3. Credit unions. Credit unions are member-owned financial cooperatives that provide similar banking services as commercial banks but operate on a non-profit basis. Members of credit unions pool their resources to provide funds for loans, and profits are returned to members in the form of lower fees and higher savings rates. 4. Investment banks. Investment banks specialize in large and complex financial transactions, such as underwriting, acting as intermediaries in mergers and acquisitions, and issuing shares or bonds to the public. They are key players in the capital markets, helping companies, governments, and other groups to plan and manage large projects, ensuring that they get the capital to finance them. 5. Savings and loan associations. Also known as thrifts, savings and loan associations focus primarily on accepting savings deposits and making mortgage and other loans. They were originally established to promote home ownership, but now offer many of the same services as commercial banks. 6. Shadow banks. Shadow banks include financial entities like hedge funds, private equity funds, and money market funds that provide services similar to traditional banks but outside normal banking regulations. They play a significant role in the financial system by providing liquidity and credit, but are also subject to less oversight, which can increase systemic risks. 7. Development banks. Development banks are government or internationally owned institutions that provide capital to promote economic development in disadvantaged regions and sectors. These banks often fund projects that private banks may deem too risky or unprofitable, such as infrastructure or education sector improvements. 8. Insurance companies. While primarily focused on risk management and insurance, many insurance companies also qualify as financial institutions because they manage large pools of capital. They invest premiums collected from their policyholders in various types of assets, creating a significant source of investment in the economy.